Am I buying Google stock? Google has crashed by 40+% since its all-time high. The company has posted its weakest quarterly growth since 2013, but all this most likely has opened an incredible opportunity from which I plan to capitalize. In this video, I'll cover their latest business results and will make a fundamental analysis which will clearly show whether or not the company is a buy or pass. As always, all is said with educational purposes and is not meant to be taken as financial advice. The top-line revenue growth of Google for Q3 of 2022 is only 6%, the lowest in close to a decade. This comes after a record increase in revenue of 41% during Q3 of 2021, with the revenue for this quarter being $69 billion. The drop in the bottom line, in other words, the earnings, is quite bad with a -27%. In Q3 of 2022, profits were about $13.9 billion, and in Q3 of 2021, the profit was almost $19 billion. The company cited reduced spending from the insurance, loan, mortgage, and crypto subcategories in particular. Worries about the economy and inflation are causing many Google customers to cut their ad budgets. Of major importance for future growth is the cloud segment. On the next chart, we can see the global market share in this space. Google has about a 5.5% share, with the leaders being Amazon and Microsoft. This segment now was a loser for Google, as losses amounted to about $650 million in Q3. But this segment is one of the most important ones, and only in the US alone the cloud market grew by 30% year on year. The biggest cash cow for Google is its search engine business, which is basically a worldwide monopoly. Google has a 92.3% market share in this space as of October of 2022, with the closest competitor being Microsoft and its search engine Bing, with about a 3.5% share. The search segment revenue grew by 4.25% during this quarter, from about $38 billion to about $39.5 billion. The YouTube revenue, which is the second biggest cash cow for the company, had a decrease in revenue from $7.2 billion to about $7.07 billion, which is about a 2.5% drop. A risk for YouTube is the fast emergence of TikTok, which takes a larger and larger share of the attention of social media users. The answer to this is the YouTube Shorts segment, and starting from 2023, this new feature will be able to be monetized by content creators. This will drive a lot of traffic to the platform, as a lot of creators will increasingly start to produce content there. What is quite interesting to me is the other bets of Google, as they consist of multiple other businesses and investments. They have grown by 10x, going from only $60 million in revenue to more than $600 million in revenue. Other bets includes businesses such as Access, Calico, Capital G, GV, Nest, Verily, Waymo, and X. The most interesting to me are Capital G and GV, which are equity investing and venture funds. Waymo is Google's self-driving software initiative, which is one of the best in the world and has the most data. Nest is a competitor of Apple Home and Amazon's Alexa smart devices. The other bet companies are mostly focusing on biotechnology type of ventures. One of the first things we must look for an investment is whether the competitors could easily come to overtake the business. Well, Google is probably the company with the biggest moat in the world, and if not the biggest, one of the biggest for sure. In the coming 5 to 10 years, I cannot see any competitor being able to compete with Google's search and YouTube. Also, as we saw, the company is starting to have more and more influence in other business segments. The company now has $116 billion in cash and short-term investments, and its total liabilities are $104 billion, which makes Google the company with one of the best balance sheets in the world. And the total assets of the company are $358 billion, giving the company an equity of $254 billion. So from a liquidity and debt perspective, Google is an absolutely spectacular business. From a business efficiency standpoint, Google is also quite terrific. The two best ways to establish whether the business has good efficiency or not is to check the ROIC and ROE metrics, according to Warren Buffett and his mentor. The ROIC of Google is enormous. Anything above a 12% return is considered very good levels, as the average return from the S&P is about 10% per year. This is our benchmark by which we can establish what a good return on capital is. If a company does not have a good return on the money it invests over the mid to long term, its business will start to erode. This is definitely not the case with Google, as its ROIC is 27.5%. Another good metric is the ROE, which stands for Return of Equity. For Google, this metric is 21.8%, which again is above 12, and it's an outstanding result. Another thing to look for when analyzing the efficiency of a company is the over time change in its net margin. As we can see over the past 10 plus years, Google's margins have consistently stayed above 20%, and now they're at around 23%, which is very good, and this margin has stayed high even with the massive expansion in Google's workforce over this year, going from 150k workers to about 185k workers. After we established that Google has a strong moat, incredible debt management, and very strong business efficiency, now it's time to see if the valuation is good. A very important thing you must remember is that there are tremendous companies which can be very bad investments. It all depends on the price. If the price is too high, even if the company is great, our returns will be bad. The best, fastest, and easiest way to compare a company's valuation is by checking the PE ratio, which now for Google stands at 17.2. From the next chart, we can see that this is the cheapest level for Google in over a decade. Only for a brief period of time between 2011 and 2012 and 2020, the company has traded at around 17 to 18 PE. This gives us an earnings yield from the business of 5.8%. We find the earnings yield when we divide 100 by the PE of 17.2. So even if Google does not grow its business, we could get a return of 5.8% over the following years. What is more likely is that Google will manage to grow in the range of 5 to 10% easily, in my opinion, as still only about 50% of the world has access to the internet, and according to the latest data from 2022, the internet market is set to grow by 4.4% annually until 2028. Alongside this, the purchasing power of consumers is going higher and higher, which will lead to higher ad spend, and still, a lot of companies do not promote their products online, which is changing by the day and each following year. So on top of the 5.8% earnings yield, we can place another 5 to 10% growth yield. All in all, I think Google is a definite buy. This does not mean the stock cannot go lower, but the reality is that if that happens, it will be a good thing for all long-term investors, as the lower the current price goes, the higher the future return will be. I hope that with all of this information I have earned your subscription to the channel. Please comment down below which other stocks you want me to cover next here on the channel. Thank you for watching, and until next time.